I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Here we are, Jim, and it's Friday, and we've had a fascinating week in the markets.
The federal court, of course, ruling that they have to have new National Energy Board hearings. What does this say about doing business in Canada and how tough it is to get through all these regulations, and even when you think you've got approval, you got to do it again?
Oh, no, that's not good business. Generally, Jim, it seems to be that the very ambitious left, which has these days endless amounts of funding through billionaires such as George Soros. But at any rate, the due process of having Parliament set the legislation or the regulations, and actually under the Harper administration, the applications for energy expansions or pipeline expansions was simplified in order to speed things up. And then you have that where the left cannot get its passions through the Parliament, they get it done through the passions of judges. And here you have another example whereby all procedures were met, and you had a very powerful and well-financed protest against it, and then a court decided in favor of the protest and against practical business. It is really disappointing, and you have the situation whereby huge reserves in Western Canada that are unable to be exported, and then you have the other pipeline issue towards eastern and central Canada, where pipelines are not allowed there, so that then you have the heavy crude being shipped from, say, Venezuela to the east coast in Canada in freighters on the pristine waters of the Atlantic, and that one's okay. Also, they're getting energy to the east coast of Canada, also energy to the east coast of the United States from Russia, of all things. So the money is going to, let's face it, government in Venezuela is very left and very ambitious, and same in the government in Russia. So the money's going to the bad guys, and the good guys in Canada are prevented from doing ordinary business. It's not good. And somewhere I hope that it's sort of a mania, Jim, going on about against energy, unless it's the renewable energy from solar cells and from windmills. And of course, this is where I was just mentioning when we were talking before the show that over a couple of glasses of wines the other night, I came up with the answer to energy shortages, and what they ought to do is put solar cells on the windmill blades. I mean, it sounds to me like a hell of an idea. What do you think?
Well, it would certainly keep them clean.
Yep. Well, anyways, we should move on from that. It's been an interesting week in the markets. Basically, 2 weeks ago, or I guess it was 3 weeks ago, there was a currency crisis focused on the Turkish lira, whereby the country had been practicing bad economics and bad financing, and the central bank was helping out until the central bank ran out of reserves. And then in that country, the short rates went up, interest rates went up, and the currency went down. U.S. dollar went up. So then the industrial commodities, crude oil, base metals got hit pretty hard, got oversold. And so we've had the rebound on that. And we want to look at on base metals, for example, copper had a terrific rally out till about May, I think it was. And then it's had a very hard correction and has rebounded. But typically you can have an important low for copper in November. And then crude oil, it came up to about 75 a few weeks ago, where it was sort of vulnerable. And then in May, I'm sort of a concerned, prudent kind of guy, and figured out that quite likely President Trump would at some point sell crude oil from the U.S. Strategic Petroleum Reserve. And that was when crude was about 71, and I just got nervous about it. And indeed, a couple of weeks ago, it was announced that the U.S. was selling some crude. And this makes sense because with huge reserves of energy, which are growing in the U.S., you don't need to be reliant upon having a government-owned strategic reserve to the size of what it has been. So it makes sense that the U.S. government would sell some crude. So anyways, but then the other thing is that no matter what would happen in crude oil through August, you've got often a seasonal low for crude out there in December, January. And there's another sense of gravity there. And then lumber, which was fabulous, what a run until May. And that's when we figured most of the commodities for this year would have their high. Anyways, lumber turned into a bubble, and then it's crashed quite hard, and new lows being made this week. So, but then lumber can sort of have a low out there in October as well. So it doesn't look so good for commodities. And then when you have weak industrial commodities, earnings certainly for producers are weakened, and you don't have the pricing abilities. So then you can't make as much money, and then a lot of these companies owe a lot of money, bonds out, so they then have trouble covering their interest rate obligations, and so then the credit rating agencies take a look at it and start downgrading. So the weakening industrial commodities, is not a good thing. It represents pricing power for many companies and industries, and when they go down, it's also suggesting that maybe somewhere in the world the economy is weakening. At the moment in North America, certainly, and England's got a strong economy as well. It's vibrant, but the whole thing is vulnerable to a change in the credit markets.
We'll have more with Bob Hoye right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, Moody's ratings agency has dropped Ford to just one grade above junk. What's happening there?
Oh, that's a sad one, Jim, because in the last crisis, and the way Obama did it was he bailed out General Motors, which should not have been done. And then the way he bailed it out was evil, because he put labor people ahead of bondholders, which bondholders have a precedence over everything. So that was a wrong move. And then Ford did not seek assistance from the government, and it's been a tough struggle. The car business is very competitive, and sometimes you just can't quite make it. So anyways, they were downrated, and that is not a good sign. And how do you, with a huge company like that, get it back on side, and you're at the top of a boom? So that's concerning on that one. And on these booms, you've got analysts out there saying, well, Goldman Sachs earlier in the year said, oh, this is a disaster. We were looking for a rebound. And then there are some big agencies out there, like the big brokers, who are looking at things and saying, oh, this is awful, it's not good. But then the way to look at it is that short-dated interest rates are still going up. That says that the boom is on. The yield curve, which is the difference between longer-dated bonds and short-dated interest rates, you can say it's still flattening, which is the trend that you get when a boom is on. Now, the one that is changing is credit spreads. That's the difference between high-grade and low-grade bonds, which in a boom, and everybody's confident, the spread narrows, and that narrowed into June, and it's beginning to change. We could say it's attempting to change trend, and that's worth monitoring, because this is just straight market forces at work. And if anybody does the historical research on the business and credit cycle, you soon realize that while the central bank can, over a period of time, lower or push rates lower than they might have been, the one thing they can't control is when you get a change in the yield curve and credit spreads. They just can't. And when you get a change in those, then you have a change to a recession. So at the moment, we could say they're still positive, but this is where, Jim, earlier in the year, we called them our friends of the bull market. And that would be rising industrial commodities, a flattening yield curve, and narrowing credit spreads. And this was likely to run into around May, and all these did. So the industrial commodities side is actually no longer friendly and is negative. The yield curve is somewhat friendly. Credit spreads are no longer friendly, but they're not really negative yet. So we've been riding the market in the right way, and you can sort of put down that we were bullish until about May, June, and then now we're getting cautiously pessimistic, because it is and has been a fabulous boom, and it is vulnerable to the same old changes in the credit markets, which there's a tiny little change so far. So we'll watch this very closely over the next few weeks for change.
And we have a listener question about gold coming up when we return.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, a listener asks, assuming there is an equity bear market beginning in the fall of 2018, gold may go down initially as it has previously done. Should long-term gold bugs who will never sell their gold acquire U.S. Treasuries, maybe with 2 to 5 year durations as a hedge against any downside in gold over the next few months?
Yeah, that's a good question. Our idea on gold is that a portfolio should own some gold, sort of like an insurance thing. But to try and make money out of gold over the last while has been difficult because in a bubble, which we've been in, and previous bubbles, the real price of gold goes down. The real price of gold has been going down, which doesn't get the stocks going either. So when a crisis comes along, of course, the really careful money goes to the most liquid items, and gold is liquid, relatively liquid. So in a crisis, there will be a bid for gold. But then also, the irony is, Jim, that in a crisis, the other liquid item are short-dated stuff, like short-dated treasuries in the senior currency. And the senior currency is still the U.S. dollar. So there'll be people buying, less than 1 year stuff. And that then puts in a bid for the dollar. So we can't see making much money out of gold, long or short, in U.S. dollars. But in the case of a crisis, the euro might fall relative to the U.S. dollar, and the Canadian dollar would fall relative. So if you're in those jurisdictions, gold would look profitable. But the best way to make money in the gold sector is in gold shares. Now, to the question, the other part of the question was about parking your money in 2 to 5 year treasuries. Yes, that would be a reasonable place to be because you have minimal credit risk. Like the U.S., well, it's not going to go broke tomorrow. And the other one is with term. If you're out beyond 5 years, the price changes may go against you. But within this, we've looked at places to put your money in contraction. And one of the friendliest is to look at high-grade corporate bonds, because you'll get a higher yield than out of treasuries or Government of Canada bonds. And then in the 3 to 4 year maturity, so then again price changes won't whipsaw you. And also with a high-grade bond, again the risk won't kill you either. But if you get U.S. corporates from, say, a Canadian account or a British account or European, then the probability is that there would be a pickup on having the U.S. dollar appreciate. And this is one of the features of previous post-bubble contractions, is that the senior currency becomes chronically strong against other currencies and commodities for most of the time. So the question's the right one, and yes to the idea of having some treasuries, but we'd say 2 to 4 years, and also make sure you got some high-grade corporates in there. You get a slightly higher yield. So there is a comfortable place, Jim, to be in a potential contraction.
Bob, thank you so much for chatting with us, and have a great Labor Day. You
too, Jim. It is a long weekend here, and I think we'll have to acknowledge it with a glass of wine or two. How about you guys?
It's my wife's birthday.
Oh, how about that? Well, wish her all the best.
Our guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for the show or for Bob, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.